Welcome to another explainer. We are diving straight in today, and I am so excited for this analysis because we're going to put a massive company through what I call the ultimate valuation gauntlet. We're looking at CRH PLC, an absolute giant in the building materials and infrastructure space. We're going to put on our expert investment analyst hats, running this company through the specific investment philosophies of legends like Warren Buffett, Peter Lynch, and Benjamin Graham, and then topping the whole thing off with some rigorous quantitative modeling like discounted cash flow. Are you ready to see how a multi-billion-dollar business holds up to the strictest tests in investing?
Okay, let's dive right into this. Here is the agenda for our valuation gauntlet. A quick CRH snapshot, the Buffett, Lynch, and Graham lenses, our quantitative models, and finally, our synthesis and recommendation.
All right, Section 1, CRH Snapshot and Overview.
So to get us grounded, CRH is an $8.5 billion infrastructure giant headquartered right in Dublin. They operate this massive, integrated network of manufacturing and distribution businesses, supplying everything from cement and asphalt to complex water infrastructure solutions. And right now, they are perfectly positioned to ride some massive growing megatrends, specifically in transportation infrastructure and a massive wave of global reindustrialization.
Let's look at the vital stats from their Q1 2026 reporting. We're talking about a market cap of $70.62 billion. Now lock this current price of $105.68 firmly in your head because that is the exact anchor we are testing against today. They're sitting at a price-to-earnings ratio of 19.57 and a dividend yield of 1.5%.
Moving on to Section 2, the Warren Buffett lens.
Now, what's really interesting about this is just how perfectly CRH checks off Buffett's qualitative boxes. Economic moat? Absolutely. They've got unmatched scale in a heavy, highly localized industry. Management? Incredibly active. They actually just agreed to divest $1.9 billion in non-core businesses while simultaneously acquiring Axios Water for $0.7 billion to really corner that water infrastructure space. They deliver super consistent earnings with an 18% jump in adjusted EBITDA in Q1 alone, high return on equity at 15.37%, and very manageable debt sitting at a 0.76 debt-to-equity ratio.
But you know Buffett, right? At the end of the day, it's all about the cash. So let's calculate his famous owner earnings using CRH's 2026 financial guidance. We take the midpoint of their net income guidance, which is about $4.0 billion. We add back the $2.3 billion in depreciation and amortization, and then we subtract the $3.0 billion they expect to spend on capital expenditures. What does that leave us? An approximate owner earnings of $3.3 billion. This right here is the true cash generation of the business.
So, what is the verdict for our Buffett lens? Look, it is undeniably a fantastic, high-quality business. However, at a $70 billion valuation for $3.3 billion in owner earnings, you're looking at a multiple of around 21 times. Buffett loves wonderful companies at fair prices, for sure. But a classic value investor like him would likely demand a much wider margin of safety before buying in at $105.68.
Let's shift gears. Section 3, the Peter Lynch lens.
First things first for Lynch, we have to categorize the stock. CRH is what you'd call a classic cyclical stalwart. It's a massive, firmly established company whose profits naturally ebb and flow with economic cycles and, honestly, the weather, since it heavily impacts construction. Yet, despite being cyclical, they are pulling off robust double-digit earnings growth, strictly driven by those infrastructure megatrends we talked about.
And that brings us to Lynch's absolute favorite metric, the PEG ratio. That's your PE ratio divided by the growth rate. Generally, a PEG of 1.0 is considered fairly valued. For CRH, their reported PEG ratio is sitting at 1.81. So while they definitely have great growth, the market is currently asking you to pay quite a premium for it. Which means our Lynch verdict has to be a hold. Yeah, the balance sheet is strong, and management is executing a nice $3 billion share buyback program. But without significant insider buying to offset their high institutional ownership, that 1.81 PEG ratio simply exceeds Lynch's ideal target for opening a brand new position.
Time for the strictest test of them all. Section 4, the Benjamin Graham lens.
And this brilliantly illustrates just how tough Graham was. Let's walk step by step through his defensive investor checklist. Adequate size? Pass, easily. Uninterrupted dividend record? Pass. They just bumped it 5% to $1.39 a quarter. Moderate PE? Pass again. 1957 is just under a strict threshold of 20. But moderate price to book? Fail. CRH's price is more than 3 times its book value, and Graham strongly preferred that multiple to be below 1.5.
Let's get into the hard math using Graham's famous intrinsic value formula. We take the square root of 22.5, multiplied by the consensus earnings per share of 592, multiplied by the book value per share. Now, where do we get book value? The balance sheet shows roughly $23 billion in shareholder equity, divided by 704 million shares, which gives us $32.77. Run all that through the formula, and Graham's strictly calculated intrinsic value comes out to just $66.07.
So our Graham verdict is a hard sell. At the current price of $105.68, there is absolutely zero margin of safety compared to that $66.07 intrinsic value we just calculated. Graham was notoriously stingy, and CRH is just way too expensive for his old-school, asset-heavy framework.
Let's move away from the gurus into pure quantitative analysis. Section 5, DCF and Alternative Valuation Models.
For our DCF base case, we are going to use that $3.3 billion owner earnings figure as our proxy for free cash flow. Now, because we don't have CRH's exact internal cost of capital in the data, we're making a calculated assumption here, plugging in an industry-standard weighted average cost of capital, or WACC, of 9.0%. For the terminal growth rate, we'll assume 2.5% to account for those megatrends. When you run through a standard DCF model, our base case actually generates a fair value of approximately $115 per share. Of course, if you run a sensitivity table varying that WACC between 8 and 10%, you'll see a fair value range stretching from $95 up to $140, but our base math suggests the stock might actually have slight upside today.
But hey, as expert analysts, we never rely on just one model, right? If we run a dividend discount model using their 1.5% yield and assuming an optimistic 5% perpetual dividend growth, we get a value of only $52 per share. That clearly shows the dividend isn't what's driving the valuation here. Alternatively, if we use a comparable PE multiple analysis, applying a standard 15x industry multiple to their $5.92 expected earnings, we land at a fair value of $88.80.
Let's bring this all together. Section 6, Synthesis and Final Recommendation.
Let's move to the master scorecard and see how this builds, because this perfectly illustrates the absolute headache of valuation. Depending on your lens, CRH is either wildly overvalued or has some solid room to run. The strict Graham formula gives us $66. Comparable multiples suggest $88, but a purely cash-based DCF points to $115. This massive variance tells us a whole lot about what the market expects right now.
So, blending the entire gauntlet together, here is our final expert recommendation. The business has incredible strengths, fantastic 18% EBD to growth, massive macro tailwinds, and management that is highly proactive with things like that Axios water deal. But the key risks? Well, valuations look really stretched on historical and Graham metrics, and the business is still vulnerable to macro conditions. Even a bad season of weather can delay construction. Therefore, our final verdict is a hold. The current price of $105.68 is essentially pricing in perfection. A true value-conscious investor should wait for a pullback into the $80 to $90 range, which lines up nicely with our comparable multiples analysis to secure a real margin of safety.
I want to leave you with this provocative thought. We just ran the numbers, but investing is also about the future. So, what do you think? Does the multi-trillion-dollar global infrastructure megatrend provide enough of an invisible margin of safety to justify paying a premium for CRH today? That's the question you really need to answer for your own portfolio. Thank you so much for joining me on this explainer. Until next time, keep analyzing, keep learning, and I'll see you in the next one.